equity, mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Great to be back for 2022 with our first interview, a returning favourite. I should say our first interview for 2022 and also our first interview ever. Back when we had no idea what we were doing.
True,
Back when I still had hair.
That's it. Well, as tradition has it, at the start of each year we do bold predictions, and it is our pleasure to welcome Andrew Brown back to deliver his bold predictions for 2022. Andrew, welcome.
Good morning, boys.
So Andrew is the Executive Director at East 72 Holdings and has been on the show plenty of times. If you've just joined Equity Mates, welcome. Can't wait to, thank you for joining the investing journey. It's going to be an awesome year. Make sure you go back and listen to some of Andrew's previous episodes and you'll understand why we're excited to have him back again.
And you'll really be able to chart the improvement in our microphone quality over the years from the first recording where I think we had one microphone between the three of us.
Yes.
And now we have so much technology surrounding us that we can barely see each other.
There's a microphone on top of a box in a 9 square metre room. So,
it's a good interview though, albeit.
Good, absolutely.
Yeah, one of our best. But look, Andrew, as we said, we're here to hear your bold predictions.
Yeah.
We've done ours last week. So now we're going to hear from you. You've got 4 sort of big thematics that we're going to touch on.
Absolutely. Let's kind of draw what I'll call the playing field or the pitch, okay, because I think that's really quite important as we go into what I think is clearly going to be a new era for the time being. So what does the pitch look like? To try and do that, let's go back 10 years, okay? Because remember, we're talking investment here. We're talking equity investments. So 10 years is not unreasonable to actually think about putting your money away. I know most people talk 5, but 10's not stupid. 10 years ago, on the 31st of December 2011, the Standard & Poor's 500 index was at 1257. The expectations for earnings in 2012 for the S&P 500 were around about 106. Okay, so the stock market in the United States, for every $1 of earnings, you are having to pay around about sort of just under $12. And at the time, and this is the really interesting bit, the 10-year bond rate in the US, so the yield on a 10-year bond in the US was 2%. Let's fast forward then 10 years to the end of 2021. And obviously 2022 started with a bit of a bang, but let's just start at the end of 2021. So in 2021, the S&P 500 was 4766.
Great 10 years.
Okay. Earnings for next year, or the current year, 2022, are expected to be 222, funnily enough. Now, that's an expectation. It may not be met. And so to move from about 105, 106 to 122 is around about 7 and a bit percent, 7.4% per annum compound growth in earnings per share for the US stock market, and that includes a tax cut. So that's not abnormal, by the way. Okay, some of you who sort of think every company grows at 15% may find that pedestrian, but that's normal, okay? Yeah. That's normal. But of course, the stock market's done way more than that. It's done 14.3% per annum compound capital growth, and it's given you some dividends as well. They're not huge, but it's given you dividends as well. So half of the stock market's gain in the last 10 years in the US has come from earnings. Okay, earnings grow. But the other half has actually come from what? It's just come from rabid enthusiasm, okay? Because the bond rate's still pretty much the same. We'll call it was about 1.5% at the end of 2021, all right? So it's people's rabid enthusiasm about the future. The earnings well into the future are going to grow at much quicker rates than they've grown at the past. So it's not what everybody tells you that interest rates have re-rated the stock market, because over 10 years they actually haven't. Okay, it's just investor enthusiasm. So that's the first little bit. We've had a lot of enthusiasm, and we've got to now try and justify that, and I think it's going to be really hard. The second thing is, of course, the stock market's done 14% plus per annum compound for 10 years. It's had one down year in 10 years, and that was 2018 when it was like minus 1 and a bit percent. It was barely measurable. So it was flat, really.
The fact that it wasn't 2020 when we had a pandemic and lockdowns is just mind-blowing still.
It is. And 8 of those 10 years, the stock market's returned over 13%. And remember, half this stuff's coming not from interest rates. It's just coming from, we're in a new era of technology and a new era of something. So the other aspect about this, of course, is that a lot of that driver in the stock market has been, a very small number of mega cap tech stocks over the last 10 years. And in 2021, those mega cap tech stocks, with one exception really over the course of the year, basically just went to Mars is probably the best way to put it. The average return from the 8 largest mega cap tech stocks in the US was 45% last year. Now, these are hardly companies that nobody's ever heard of. Okay, what are the 8? Everybody conceives their own thing. I now call them Mammonant because it's a
we've been calling them Ant Mama.
Ant Mama. So it's the same thing. So just if you have been living under a rock, it's basically Microsoft, Apple, Meta, which is obviously the old Facebook, Amazon, and then Netflix, Alphabet, Nvidia, and Tesla.
Yeah, you see, we take Netflix out of it because every other company there is like 800 billion plus. Netflix is around 300 billion.
Exactly.
Yeah.
Well, the aspect of it that's crucial is those companies make up about 28% of the S&P 500. Okay, now they obviously weren't that 10 years ago, and so they've driven forward. So what it tells you that the S&P's returned 14+% over compound over 10 years. These guys have obviously gone nuts over that period of time. And so there's a whole bunch of other companies out there that haven't returned anywhere close to 14%.
The rest of the stock market.
They call it the rest of the stock market. So what you have as we've entered into 2022 is we have a situation where interest rates can't really go any lower. They've been at their low on a 10-year bond. The low was about 1% in February of 2021, and they finished the year at about 1.5%. And in the first 12 trading days of 2022, since we're recording this on the 20th of January 2022, yields have jumped 35 basis points, or 1/3%. So rates are going up. Inflation is over 7% in the US, okay, and interest rates clearly don't reflect that. And everybody's talking about inflation. Now, if everybody's talking about something, it's usually a good idea to talk about something else. Subtle hint, okay? There's a good chance that inflation ain't going to go much higher. I'm not saying it's peaked, but it may not go much higher. It may not come down quickly, but this may be the sort of the it. But interest rates haven't caught up with inflation yet. And so what's going to happen over the course of the year is that long-term bond yields will rise, in my opinion, and probably have a 3 in front of them at some stage. Short-term interest rates are going to rise because the Federal Reserve is going to push them up anyway. And as the Federal Reserve withdraws from buying government securities, which of course pushes their price up and keeps their yields down, then the demand for government securities that yield next to nothing by anyone else on the planet is pretty small. So the yields are going to rise, and they're going to rise a little bit in Europe. They're going to rise in Australia as well, despite what the Reserve Bank think. And so we're going to have a situation where interest rates are not going to normalise, but they're going to start on a pathway to normalising. And so you've got a situation where, as we built the pitch, this stock market has risen strongly over a 10-year period with only one down year, and interest rates have not been the contributing factor to at least half of that rise. It's just enthusiasm by investors about whatever. Okay, we can call it tech, we can call it the cloud, we can call it green, we can call it crypto, we can call it the meta, we call it whatever you want, okay? It's just enthusiasm about the future. And when people build in too much enthusiasm about the future, you usually have a problem.
Why do you think that's going to change this year, though?
Because interest rates make it more difficult to sustain, or rising interest rates make it more difficult for you to sustain your investment in a long-term growth story that doesn't grow or that has hiccups along the way. If you don't think that investors don't get legged up by these things and they overprice things too much, let's look at 2021. For as much as the top 8 mega tech stocks, excluding Amazon, were fantastic performers in 2021. I mean, Meta was sort of fairly boring, and he did about sort of, over the course of the year, and he did 23%. It was sort of, one of the other boring ones. But, you saw a whole heap, as we discussed back in our December podcast, a whole heap of second-line tech stocks got murdered. Because they didn't live up to their business model. Yeah. Okay. And interest rates, people started to get worried about the business model. So they don't just fall a little bit. They get absolutely, they just get massacred, as we most obviously saw. Peloton's the best example, I think. So the issue is going to be for people, as interest rates rise, it becomes more difficult to sustain your investment in these kind of companies. Their long-term, if you're correct about the company and you had perfect foresight, they're a long-term income stream, a very long-term income stream. And clearly, as interest rates go up, the value of that income stream is going to come down. But one of the reasons I'm so excited about 2022 from an investment standpoint, and particularly from the standpoint of people listening to Equity Mates, a slightly younger population than me, is that you cannot just invest on themes. One of the things you maybe been able to do in the last few years is be a thematic investor. So you've invested maybe in green technology. The best investment theme has been mega cap tech. Let's be blunt. You just had to put that in your mind, go to sleep, wake up and count your money. It's been as simple as that. You're not going to be able to do that in 2022. You're going to have to do some real work, and you're going to end up, if you buy stocks or even if you buy ETFs, with, I think, a really eclectic portfolio of stuff. And I don't mind telling you, my portfolio right now is the most eclectic and strange it's been in a very, very long time. Seriously.
It must be.
Yeah.
Oh, yeah.
Because you had some pretty wacky stuff in
I
there.
had some wacky stuff anyway. But
it wasn't vanilla to begin with.
Yeah, absolutely. So right at the outset, I think it's highly likely that the US stock market will not produce a positive return in 2022.
Okay, well, that we're looking for bold predictions here, and I think we mark that down as your first bold prediction.
Mark it down as a bold prediction.
Actually, we should also mark down that 10-year bond will have a 3 in front of it.
At some stage during the year.
Yeah. There we go. We
Absolutely.
got 2.
And I don't think the US stock market will have a positive trend. Why is that? Well, earnings expectations are for earnings growth of about 10%. I think that's a bit too easy. That's a bit like sort of pin the tail on the donkey stuff. And I think one of the issues is going to be, where do you get 10% earnings growth from in such an uncertain world? And the uncertainty is not just COVID. It's not just supply chains. It's not just inflation. It's not just labour shortages, which is in a sense one and the same as inflation. But it's also the fact that, the consumer's starting to get kicked around in the US a little bit as well. And consumer confidence is starting to wane a bit. And the consumer in the US is the economy, as you well know. So that there is a real chance in a year when you have midterm elections, so the T word gets put back in the vocabulary, unfortunately, RUMP. Yeah. Okay. That's going to create a lot of uncertainty again, in my opinion. So I think it's really likely that trying to get 10% earnings growth out of the US in this type of environment may not be that easy. Okay. Yeah. And it's earnings growth that's got to drive the market, because, as I've said, there's not interest rates going to drive it, and there's not enthusiasm by investors going to drive it, because they've driven out enough already. So it's got to come from earnings growth. So if you're buying expensive growth stocks, you better make sure they're going to grow. this year, because if they don't, they're going to be a little bit troublesome. And that might even include some of the big eight.
Yeah, it's interesting though, because time and time again, those big ant mama stocks
Oh, yeah.
continue to surprise the market. Apple every time, Amazon every time.
Yeah.
Alphabet
Not
every
Amazon,
time.
not Amazon every time. Amazon is at a very interesting juncture. Okay, obviously without its, not without, but its founding father has stepped back. Its retail business is under much greater pressure from competitors now. The Targets of the world, the Walmarts of the world. No, there are potentially emerging issues about AWS. But, it's not quite the strong behemoth that everybody thought a year to 18 months ago. Now, that's reflected in the stock market. The stock returned 2.5% last year. So, it's not like we're saying anything new.
So are you making a third bold prediction that Amazon will be the worst performing of those 7?
No.
Okay.
Absolutely not.
trying to coax some impromptu ones out.
No, the chances are it might be one of the better performing of those 7.
Okay, well, that's the
Is that the prediction?
Yeah, I think, it's going to play catch up. But, as you're going to find out in a second, I'm not looking at those technology stocks to make money out of. Okay. Because quite clearly, what I've painted as the 10-year picture, I'm looking around for things that are really, really good businesses but have not been led up in price, way in excess of valuation by investor enthusiasm. And so I'm looking in other places where people are reticent, but where the underlying businesses are really, really good. Okay?
I guess one thing some people may say is what we see from these mega cap tech stocks is that they build such operating leverage into their business that as they grow, it just all falls down to their profit line.
Yeah.
And so maybe it justifies bigger multiples.
The bigger multiple justification is not just that, but in most cases, not all of the big eight, their capital management is pretty amazing. Apple is astonishing. You basically issue very, very long-term debt at nothing, and then just use it to buy back your own stock in droves, and their cash flow drives that as well. So Apple can go a long, long way and can actually load up at quite a bit more net debt onto the balance sheet, before they would start to worry. So their capital management's been amazing. I think Google's capital management is amazing as well. Microsoft obviously have literally done a bit ago made their big move to try and kill off everybody else in the gaming space. Each of these companies has got their own different ways of managing capital and gaining operating leverage. But for Nvidia, it's not always the case with that. There's plenty of other leverage that operates on Nvidia, which is obviously what's going on in the chip market for them, or in their bit of the market, etc.
It doesn't apply to all of them. Like you wouldn't say the same thing about Tesla.
No. And they're each of them are market leaders in their own particular way as well, and that brings with it its own capabilities. But don't forget each decade, each 15 years, market leadership of stuff changes. So and you don't necessarily see where it's coming from. So
where does that leave us?
Okay, where do we go? Where do we go looking? For things that are really, where there is genuine value and there's still some growth, and they're really pretty cheap and nobody wants to know. Okay, well, there's a myriad of things.
And before we jump into that, we will just take a really quick break to hear from our sponsors. Okay, Andrew, myriad of things. Where are we looking?
Okay, the most obvious place to look, because everybody else has said, we are not playing here anymore. We don't want to play on your pitch anymore. We're leaving. And we've sold our stock and left.
Can I guess?
Have a guess.
China.
Nice. Absolutely right.
So, Andrew, we do a stock of the year every year, and every year I manage to lose money. And then the next year, the stock that I picked does really well.
Yes.
Happened with Costa, happened with Atomos.
Yep.
I think it's about to happen with Tencent this year.
Yeah. The really critical thing is, number one, the Chinese market was down around about 16% last year, and obviously it dragged Hong Kong down with it. Why? Effectively, it was obviously all to do with tougher government policy, common prosperity, the two key words, a lot more regulation. And it may be the Chinese government feel they've over-regulated because the economy did slow quite strongly at certain stages last year, not in the last quarter because the numbers there were very good. But what they've done in China, you've actually got looser monetary policy, whereas you've got tighter monetary policy elsewhere.
And you got Xi Jinping at Davos begging the rest of the world to not tighten.
Yeah. So what you've got now is you've got a group of large companies in China that now know what the rules are. 2 years ago, they didn't. The rules got changed on them perhaps quite abruptly, and obviously it had a massive impact on their stock prices, a delayed impact on their stock prices. Alibaba is your traffic light for that one, okay? So if you don't want to buy an individual stock because you're a little bit worried, because they do operate in different ways, and they do operate in different things, buy a basket of them. So I've highlighted this before. My favourite basket is the Crane Shares China CSI China Internet, K-Web, listed in the US. Of the companies, I think Tencent is probably the most interesting to me. And obviously Tencent controls Tencent Entertainment, which we discussed the music industry last time I came in here as well. It's got a big stake in Universal Music. So I think to try and buy a basket of Chinese stocks, particularly the mega cap tech stocks, is the way to go, because they're all now trading on basically fairly low teens PEs. Yes, that you can throw all the old issues. They've got variable interest structures. There's issues about the listings in the US. Some of them are a bit impenetrable from an account standpoint, et cetera, et cetera, et cetera. That's been the case even when people were paying 35 times earnings for these things. You're now not paying anywhere near that. They've come down a lot. I think they're very, very interesting to look at. And as you know, many of the major mega cap tech stocks in the US are effectively shut out of China. So they create their own little local monopolies and oligopolies. The second place to look, okay, so China, you can either look on a stock-specific basis. I've said I'd rather play it on a basket basis. The second place to look is Hong Kong, because Hong Kong got really shredded because Hong Kong was supposed to have some degree of autonomy from China. And obviously, as we saw in 2021, that disappeared by and large. Does that mean Hong Kong's stock market has disappeared? No. Does it mean that Hong Kong's economy has disappeared? Well, it's slowed. Okay, but there are a whole heap of absolutely fantastic companies in Hong Kong, and by and large, their share prices did next to nothing last year, and indeed, obviously, as a group, went down about 15%. My favourite play in Hong Kong, and it has the ticker symbol 1. Oh, actually, 0001. 1.Hong Kong is basically C.K. Hutchison, which is the Lee family or Lee Ka-shing's master company. Okay, it's basically got port assets around the world, but particularly obviously in that part of the world. It has massive telecommunications assets in Europe through the 3 network. It has retail in Asia, and it has a massive infrastructure business, which you would know in Australia. And that's conducted through about a 78% controlled subsidiary called CK Infrastructure, which is listed in Hong Kong. But when you put together CK Hutchison, you can't find any value fund manager who thinks the stock, which is trading at about 55 Hong Kong dollars, is worth less than about 85. Massively undervalued. It's on a PE of 5.
Wow.
Okay. And it's giving you things which, some of which are long-term income streams like infrastructure. You might argue ports are as well, but ports will continue to do okay as they unjam themselves. Telecoms is a long-term income stream as well, and there's a lot happening in telecoms in Europe. And as you know, one of my themes in talking with you guys consistently over the last 5 years has been, if someone's a billionaire and they've grown it themselves from nothing, Why go against them? Why not park alongside them and hitch a ride? Okay. And so you're doing that with effectively what was the richest family in Hong Kong, the Lee family.
You love a family-controlled conglomerate.
I
like
do,
no one
absolutely.
else. Yeah.
Why not? And this has been dull as ditch water for years. I accept that. Okay. Every value fund in the world has owned this thing, and it's call it a dog's insulting, but it's been very, very dull. Okay. And it's certainly worth 60% more than the prevailing share price. So I think that's really, really well worth a look. In Hong Kong, I wouldn't buy an ETF. I would go stock picking. Okay. One of the obvious things, if you think capital markets in the region are going to liven up a little bit, and if you're worried about Chinese companies being shut out from the US market, where are they all going to have better listings? Hong Kong.
Yeah.
So you can buy Hong Kong Exchange, for example, as a stock exchange there. So really look in Asia, because there's a lot more bargains in Asia, and in particular look in China. Let's use the same theme, okay?
Yep.
There's one other market which is actually very, very big. It has some astonishing companies, and particularly just as we speak, for reasons which are extremely obvious, called the Ukraine border, there are a stack of things in Russia that are about as cheap as they ever get. One hint on buying Russian stocks. Number one, you can buy them in London. So you can buy all these things through global depository receipts in London. So you don't have to open an account with a stockbroker. You'd prefer not to. But the second thing is you always buy Russian stocks when there's a political problem. Okay, because they can run extremely hard and get not super expensive, but a little expensive, but they fall to pieces whenever there's a risk of some real political upheaval. And the political upheavals usually revolve around the armed forces.
Yeah, right.
Okay, and they usually revolve around the armed forces sort of poking their nose into a former Soviet republic. Okay, and as we speak, of course, that may or may not be happening with Ukraine, which has obviously been the one that has been where the tension has largely been over the last 5 years. So what that's done is it's taken a lot of these Russian stocks down quite heftily. There are two stocks in Russia I think are absolutely spectacular. Okay, the first is Russia's biggest bank, which is called Sberbank. SBERBANK. It trades in London as well. It is 50% plus one share owned by the Russian Ministry of Finance. That sounds tricky. It's actually not, because Sberbank has roughly 44% market share of loans and deposits in Russia. So the Russian Ministry of Finance needs Sberbank to be strong, highly profitable, pay very attractive dividends back to it, and make sure the locals don't lose confidence in Sberbank as just being going to have their money sucked up. They've just reported some preliminary numbers for 2021, so they're very preliminary. The bank made a profit of 1.273 trillion rubles.
What's that in US dollars?
Yeah, what's that in real money? It's about 16 billion US dollars.
No, that's not bad.
It's a 24.5% return on equity. And the stock's market cap is 73 billion US. It trades on a PE of 4.5.
And the Russian finance minister owns a controlling interest in it.
Yeah, 50%.
So it would be like in Australia if Simon Birmingham, who's our finance minister, or Frydenberg, who's our treasurer.
It's a Ministry of Finance. But
not the minister.
Not the minister. No, the Ministry of Finance.
Right, so the Russian
Ministry of Finance are
yeah.
not going to mess about with it.
Oh, that makes more sense. That's just like, that's just an unbelievable conflict.
Now,
what happened first? Were they minister or did they own it?
About 25% of it is owned by global investors through the London GDRs, okay, as well. The great thing about Sberbank is, can you imagine a much bigger Commonwealth bank, a much bigger market share than it has, so like twice the market share it has, also having an e-commerce platform?
Interesting.
Okay.
That's Sberbank. That's what Sberbank's got.
Like an Amazon vibe, like selling a bit of everything? Absolutely.
So, I mean, the best thing I can suggest to you is Sberbank has lots of English language presentations, including an investor day back in November. If you want to meet the person you do not want to find on the other end of the now Microsoft-owned World of Warcraft, Just have a look at the Sberbank thing, the Russian rocket scientist. Okay. This bank is so smart, it's not funny. It's got great technology and it's back down at a level which is just under $13 for the depository receipts, which are 4-1 on the underlying Russian ruble stock. So, and it's been brought back down there by just general Russian fears and everything else. Don't forget the Russian economy quite enjoying things at the moment. Why? Look at the oil price.
Yeah.
So why not buy Russia's biggest oil producer?
Yeah.
Okay.
Is it
Gazprom.
Yeah.
You can buy Gazprom. Gazprom is on a P of 3.
Wow.
Gazprom is lower in share price terms in US dollars through its London listing again than it was in June. Okay.
Are they also big? Like, are they the big gas producer as
Ah,
well?
very good.
Okay.
Yes.
How are they only on a P of 3?
Well, have you seen the gas price to those lovely German consumers in the last 6 months?
Yeah.
I think Willy and Hildegard are just basically buying a few extra blankets because they can't afford the gas.
Yeah.
Okay, so basically Gazprom's on a P of about 3 and a bit. I'm going to suggest, and you can find this stuff, okay? It's really easy to find. This is somebody I've never mentioned in these podcasts before. There's a wonderful guy in Perth called Willie Packer. He used to be an analyst for a couple of brokers a long, long time ago, and in 1993 he set up his own business called Packer & Co. No relation to some more famous Packers. And he runs a thing called the Investigator Trust. He runs it out of Perth, and you've never heard of it, and it's got a meagre $2.25 billion under management.
Wow.
He writes very quirky, really common sense letters twice a year and only about 6 to 7 pages, and they're so simple your grandmother could understand them. And I love reading them because they're so simple. There's nothing, they're not going to win any academic awards, but they're just common sense beyond belief. This gentleman has 35% of his fund in cash, and he's got 35% in Russian and Chinese stocks.
Wow.
Okay, his biggest Chinese stock is China Telecom. He's also got CNOOC. Okay, and his Russian stocks, he may have Sberbank, but it's not disclosed if he does. But his Russian stocks are pretty much all oil and gas stocks. Gazprom is his biggest position. It's about 8-9% of his fund.
Wow.
Okay. I think he's, I wouldn't make it 8 or 9% of my fund, but I think he's on the right lines. So it's one of the cheapest oil stocks in the world.
Yeah.
So, remember, if you were listening to October 2020, I told you to buy Exxon at 34, it's 72. So it's sort of doubled, and each of the US companies have got their own little quirks and everything else. But this one, despite the oil price being at a high, so don't put 20% of your portfolio into it, but it might be worth a look, and it is buyable through these things. If you like the Russian story generally, then obviously there are Russian ETFs that you can have a look at. Okay, but so I'm looking at those kind of things. What else am I looking at? With this stock market like last year, it's now so bifurcated, in other words, in two directions. It's not funny. So we've got these expensive but high-quality megatech stocks, but we've still got stacks of cheap value stocks, and they're now getting more attention from people. They're either in a cyclical part of the economy that's now going to grow and benefit from price rises. A lot of things for them have been made better by what's gone on. So to give you an idea, let's look at 2 or 3, very special things that might be interesting. One is Bayer, the chemical business.
Oh, yeah.
Okay, in Germany. Bayer's on a P of about 7 or 8. Just remember, when German companies make big acquisitions, run for the hills.
Yeah.
The 2 worst acquisitions in Europe, in top 10 worst of all time, were both made by German companies. Daimler's merger with Chrysler, which obviously they then unravelled, thankfully, later on. And, of course, Bayer spent $62 billion on Monsanto and bought itself a little thing called Roundup.
Bought itself a lot of lawsuits.
So it's basically getting it together. It's obviously in an area where basically it does have some pricing power. Okay. And the stock's done nothing much over the past 6 to 9 months. So I think that is well worth a look. It's again, it's in that sort of, value area, specialty area. I'm looking at some fallen angels in tech.
Okay.
No.
After paying Zip?
No. One of the most interesting ideas I've got, and I do have a holding in it, is Dropbox.
Oh, interesting.
Okay. Dropbox is $9 billion business, market cap. It's got net cash. It's got Elliott Associates on the register, which is generally a good thing. Hello, BHP.
Well, Twitter had them, but nothing seemed
nothing seemed to happen. Dropbox is interesting because they've definitely changed tack. Okay. I will acknowledge we can argue all morning long as to whether Dropbox is a viable long-term business, and you will both say no, and I won't disagree with you.
Yeah, well, as a business that runs on the free Google Drive system,
absolutely.
Yeah.
Okay. Dropbox
We pay for it, but yeah.
But it can be free.
It can be free. Yeah. Dropbox is expensive.
It's all these video files that you keep making.
Dropbox has got really expensive over the past couple of years.
Yeah.
They've really been hiking prices without people people like me realise, because I'm no longer a customer of Dropbox in one area of my business. I am in another, but not in the main area. It's gone elsewhere. Okay. But Dropbox works really well. It is by far and away the best for small and medium business for these kind of cloud storage. Okay, if you're a mega business, no, it's not. But what Dropbox is starting to do, and please bear in mind, is about $250 million worth of stock issuance every year to employees. Okay, but their free cash flow is going to get to around $1 billion in 2022, including that stock issuance. Okay, so it's a bit of a cheat there, but they're starting to buy back stock at a rate of knots, with Elliott's finger strategically, positioned between their shoulder blades to make sure they don't go away. What it means is, the stock is actually relatively cheap. So you've got $1 billion potentially of free cash flow on a sort of $9 billion equity company.
Yeah, wow.
That's pretty interesting in that kind of tech space. It is still growing customers, but I will acknowledge it's not the best of the bunch by any means, but well worth a look, because they're the kind of things that you start to get when you get a fallout in tech. You actually do get some values. My quirkiest stock, because I want to explain that there is such a thing as the best business in the world.
Okay.
You all think the best business in the world is Apple and Microsoft and Google and things like that. Okay. The best business in the world is none of those. The best business in the world has very few employees. But the best business in the world is a 108-kilometre long toll concession that runs around the city of Toronto.
Okay.
And it's called ETR 407. Okay. It used to be called Highway 407, but now the government bit is called Highway 407. It's the other 40 odd kilometres of a 150 kilometre link. Okay.
Right.
Okay. If you've ever been to Toronto, there are two things about Toronto. Three. Number one, it shouldn't be in Canada. It should be in the United States. It's an American city that happens to be over the border.
Okay.
Number two is it's got shit tons of traffic congestion. And number three, people's obsession with property makes people in Sydney's obsession with property look like a mere interest.
Really? Okay. There
Absolutely.
You go.
Okay. Now, ETR 407 is owned by three companies, or three people. One is Canada's public CPPIP that's made a number of investments here. They own 50% of it. Secondly, a company called Sintra, which Macquarie used to have an interest in going back 20-odd years. And Macquarie sold part of 407 to CPPIP through the takeover of Intol, which was listed in Australia briefly. Ferrovial in Spain owns Sintra, and it owns 43% roughly of the road. So that leaves 7. Who owns the 7? The 7 is owned by a company in Canada called SNC Lavalin. If you Google SNC Lavalin, all you will see is the 5-letter word fraud. Okay, because they were indicted for basically fraudulent contracts by the Canadian government, and the share price got absolutely cratered as a consequence of that in 2019. And these guys used to own 17% of ETR 407, and that's sell 10% for $3.2 billion in 2019. Why is ETR 407 the best business
This
in the
was
world?
the question that I wanted to get to.
Simple.
Yeah.
It's full electronic tolling. It is full variable tolling. So it's variable tolls. So if you go and there's nobody on it, you don't pay very much. If you go and there's a load of people on it, you pay a ton. Okay? The average toll is about 50 cents a kilometre in peak hour between 7:30 and 9:30 in the morning.
50 cents a kilometre, and it's a 50 kilometre.
No, it's a 108 long kilometre stretch. Now, nobody's going to do 108 kilometres on it, I can assure you.
Yeah, right.
Okay? But what it means is it's basically and it's inflation proofed. Okay, so it's electronic variable tolling that's inflation proof. It's the first electronic variable tolling highway in the world.
There you go.
Okay, and Macquarie sold it. Sorry, big mistake, boys. Big mistake. Okay, so SNC-Lavalin's got a market cap of 5 billion Canadian. Okay, I think that asset is worth 2. They are one of the biggest engineers in nuclear anywhere in North America, and whatever your views on nuclear, I think the fact is it's coming back. Whether you want it to or not, it's coming back as part of the green move. They are working off some what are called long-term or lump sum turnkey projects, which in contracting language is a license to lose money. In other words, it's a fixed project that's complex. Sorry, fixed price projects, complex. They've got 3 left. They're working those off. And what they've also got is a really, really good engineering business in the UK. So it's a fascinating, it's another one of this sector of companies around the world where the stock market hates construction companies and it hates engineering companies that build stuff. So, we've discussed in the past CIMIC on here. Lend-Lease, I'm an owner of. I know it's not infrastructure and we don't want Lend-Lease in engineering. Thank you very much, because they're no good at it. Okay. But CIMIC are good at it, and CIMIC is not half as cheap as its parent, which I do own, which is Hochschief in Germany. Imagine in this sort of world of dross, there's a Canadian company that owns $2 billion worth of the best asset in the world. Okay, the shares have jumped from their lows, but they're still ridiculously cheap. Elsewhere, obviously, I think if you don't have some gold in this environment, you're nuts. Just as a hedge, and the best way for me are the 2 Van Eck gold mining ETFs, which I own.
What about digital gold?
I do believe one of the things I think is really going to happen over the course of 2022 is I believe the crypto world is going to go through some fairly significant upheaval.
Okay. Hit that as a bold prediction.
You can hit that as a bold prediction. And the upheaval is going to mean that Bitcoin and to a degree Ethereum are going to get moved out of fashion.
Okay.
Because Bitcoin does nothing. It does zero. It has
people
no
listening
use.
and disagree, take it up with Andrew.
Yeah, take it up with me. It does nothing. Ethereum does some things. We know Solana does some more things, and then there's a whole lot of other coins which you can ring me up and tell me about, which do lots and lots of things, and will play a role in the metaverse, and they will play a role in distributed ledger technology. They may play a minor role in fintech. I think what's going to happen is in the crypto world, the regulators are starting to come in a world where interest rates are going up, so your speculation is no longer free, where too many of the old coins are controlled by whales. These things are oligopolies.
Yeah.
Don't come and tell me you love crypto because you are rebelling against the world and you want a new world. That's a nonsense. You're not. You're making the rich people even richer. Okay. I urge you to read a piece by Scott Galloway, which is published recently, which is called Web3.
Yeah.
Okay. And it's about how many of you think Web3 is wonderful, but it's the same old oligopolists. It's just a new bunch of oligopolists trying to get rid of the old bunch of oligopolists. Well, if you want to do that, you might as well reinvest in Russian equities. Think about it. Okay. So I think there's going to be a lot of upheaval in crypto, which, will start to play a bit of havoc with speculation. I do think there's going to be a lot more volatility because, these moves, this bifurcation in markets is going to create vol.
Yep.
Okay. And so Everyone knows I've mentioned it 108 times. So here's the 109, which is Virtue in America, the only listed liquidity supplier in the world other than Flow Traders in Amsterdam. It benefits from vol. It's got great tech. It's sort of seen to be doing about 6 to 7% of US equity volumes. And it's got nothing in options. And don't forget, you all know that options were the driver last year, which is why Citadel made so much money. And Citadel have just sold a stake in themselves.
Well, Andrew, a few minutes left.
Yeah.
Let's come home.
Yeah.
Yeah.
What do you want to close it out with?
Well, in Australia, I mean, to be quite honest with you, if I think China's going to be a more interesting environment, then certain things in Australia are probably going to be okay. So I think, you should have some commodity exposure, obviously. That's going to be commodity by commodity. So copper, there's very few plays, unfortunately. Iron ore is interesting. I think it's come off the bottom. The stock prices, unfortunately, have reacted really aggressively to that. I mean, you could have bought Fortescue at $14 3 months ago, and it's now 23. So it's a big rise. My favourite is Deterra. It's a long-term income stream, which is the royalty over BHP's MAC mining area and their south flank and the growth that comes from that. It's pure royalty. So it's pure price and volume play on iron ore. I think that's the safest way to go, but there'll be trading opportunities in the other things. Obviously, if what I said about gold is right, well, you pick your own gold stocks. Banks are interesting because I think the Australian economy is going to be a lot more difficult than people imagine. Don't forget, we've got an election. That election is going to be close. I think there will be a change of government, but they're not going to have a majority in the upper house. There's lots of people postulating who do I put last in the Queensland Senate, because there's a whole lot of extreme right wingers that are standing for those Queensland Senate places, and some of them will get in, and so they're going to make life difficult for a Labor government. They're going to have to deal with personalities and don't love. There's a chance there might be a few independent MPs in the lower house. I don't think there'll be heaps, and people are getting very enthusiastic about it in the wake of Zali Steggall and others. So, it could be tricky that Labor win, but the majority in the lower house isn't even that great, and that they don't get an upper house majority. That's not good for the economy. Okay, because we know the Liberal Party are much better at destroying things and building things. Unfortunately, they demonstrated that. It's not a political comment. I think it's fact. So Australia could be interesting, and if the economy is a lot slower and property prices start to come off, and they will.
That is a bold prediction.
No, property debt is 96% of GDP.
Are you saying property prices will be lower than?
Yes.
Write that down. That's a bold prediction.
Yeah, nobody expects it.
No.
If interest rates go, and you've got to say, I mean, the one institution, you can criticise a lot of institutions in Australia, but the one that in all seriousness, you really should criticise is the Reserve Bank of Australia. They have lost the plot. They live in a world of their own, and this property debt that's grown up to be equivalent to the size of the economy. That's a problem with rates where they are and prices of property where it is. So there's only really one way that can go, and I think that might make life difficult for the banks, even though they'll get a bit of a respite from interest rates going up. There are going to be other sides of things that are difficult for them. They're going to have to take costs out of their business. The biggest issue for any business in the world is costs. Labour costs are going up, other costs are going up as well, and it's labour costs that are sticky. And remember, the big thing about inflation, where I might be wrong, what you don't want to see in inflation, and it's starting to happen, is inflation expectations rise. People are starting to say, I want a pay rise. Why? Because my bus fare's more. This is more, that costs more, something else costs more. We know stuff costs more temporarily because of supply chains, but if it's still costing a lot more 2/3 of the way through 2022, then we have a problem, okay? And Australia's not immune from that. You read the Financial Review, it sits there thinking we're immune from all this stuff. Get out of here, we're not, absolutely not. And Australia's banks, they're going to have to restructure themselves. It's quite clear they're way behind the 8 ball on fintech, apart from CommBank, but they've got too many people, they're going to have to restructure. So when you look at the top 10 stocks, you've got the 3 big iron ore miners, BHP, Rio, Fortescue. You got the 5 big banks now because
Macquarie.
People love valuing Macquarie's trading income at 16 times earnings, but they only value Virtue's trading income at 11. Interesting dichotomy. Then you got Wesfarmers, which is the economy, and then CSL with a new acquisition, then Woolies after that. Yeah. So I don't think the Aussie market will be that bad, but I just don't see it being that good. And there's a lot of overpriced mid caps in the middle, maybe good companies, but they're just way too expensive. And in a rising interest rate environment, they're really going to have to move, and their cost base is not going to make it easy. So to be quite frank, you've got to stop picking Australia. I'd rather be on the resource side plus selected micro caps.
Now, Andrew,
Nice.
we've only got 2 minutes, but there's one thing in your notes that you didn't touch on that 60 seconds or less. Let's get your 2 cents.
Yeah.
You've got Magellan down.
Yeah, Magellan's fascinating. With the stock having come back. First thing, fund managers going nowhere trade on PEs between 7 and 10. Okay, you can go back and look at things like Franklin in the US a few years ago. They were down at a PE of 7. Okay, so they're an active manager. Okay, so they've got to add value, and obviously they've scrambled to do that for a variety of reasons, and now they've lost their biggest client. If you go on my Twitter feed at Abron Investor, if you look back and use the search function and put, $MFG.AX, which is the stock code, I did quite a long thread where I said I'd get interested about $18. They're not there yet. And sort of 15, I'd get really interested. I think the people are great. Okay. Everybody loves to cut the tall poppy down, and that's pretty ordinary to see what goes on there. Hamish is he's extremely talented, and don't forget he's got Chris Mackay doesn't work at Magellan, but he's clearly one of the founding people there. He's on the board, and he's a mentor. So the reason for picking that $15 to $18 is basically to take the funds under management down to a level basically around about below 100 billion. Okay, so it's sort of 90 odd billion at 60 basis points. That's a question mark, and their fixed cost base, and you end up basically with about $1.80 a share of earnings. Okay, so 10 times $1.80 is $18. It's as simple as that. Obviously, there's some calculations and workings to get to a sustaining earnings number, and these guys do better in bear markets.
Yeah.
Okay, so when the dust is settled, and there'll be some more outflows, of course. Just fund managers are like dominoes. When one client goes, there's 10 behind them. But once that settles, it could get very, very interesting.
Well, hopefully they do better in a bear market. Otherwise, they're in a lot of trouble.
That's implicit in that is that you're hoping for a bear market. So,
well, it'd be interesting to see if they do.
Just finally, other cheapies. I actually own Herbalife.
Okay.
I suggest all of you read John Hempton's letters, which are up on his website, Bronte Capital. I think John, in his own way, has effectively peaked the environment the same as me.
Okay.
Which is John is short what he calls crap, and he's long good companies. And
John's always short crap, though.
Yeah, he's always short crap.
Well, John is one of our white whales here at Equity Mates. He's said no to us a few times, but one day we'll get him on. You'll get him on,
and this is the kind of environment he does really, really well, and his December numbers show that. So Herbalife's one of his longs. He's been adding. The stock's been pretty dull for the last couple of years, but again, it's on P of 10, and it mints cash. And I think it's got pricing power.
There you go.
Nice one. Well, Andrew, we will have to leave it there. But as always, thanks for kicking off the year with us.
Absolutely.
Left plenty of stocks for the audience to go through and have a think about.
Yeah. But please, everybody, the big lesson is don't think narrowly in 2022. You might have been able to in 2020 for part of it at least, and certainly in 2021. Do not think narrowly in 2022, because if you do, you'll come a cropper. But the good news is, by not thinking narrowly, you're going to learn a lot.
Yeah, some good bold predictions there. We've made a note of them, and we'll be watching, and we'll get you back on, and we'll see how we go.
I will look forward to it whenever that may be.
Yeah,
so that's great.
Thanks, Andrew.
Thanks, guys.
Equity Mates Investing Podcast is a product of Equity Mates Media. All information in this podcast is for education and entertainment purposes only. Equity Mates gives listeners access to information and educational content provided by a range of financial service professionals. It is not intended as a substitute for professional finance, legal, or tax advice. The hosts of Equity Mates Investing Podcast are not financial professionals and are not aware of your personal financial circumstances. Equity Mates Media does not operate under an Australian Financial Services Licence and relies on the exemption available under the Corporations Act 2001 in respect of any information or advice given. Before making any financial decisions, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. Do not take financial advice from a podcast or video. For more information, head to the disclaimer page on the Equity Mates website, where you can find ASIC resources and find a registered financial professional near you. In the spirit of reconciliation, Equity Mates Media and the hosts of Equity Mates Investing Podcast acknowledge the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders, past and present, and extend that respect to all Aboriginal and Torres Strait Islander people today.